In this lesson, we will be discussing accounting for bonds under three different scenarios. Issues of bonds at face, at a discount, or a premium. Under each scenario, we will be generalizing the bond issue event, the interest payment, and the amortization of the bond discount or premium under the last two scenarios, and three, the bond call or retirement. Now, this third one, I'm going to defer that to a different part of this lesson. So we'll just focus on the first two here. So let's begin by setting up the scenario here. Smith Company is the investor, also known as a creditor in this case. And Smith Company has a number of investment opportunities out in the market, which will provide the company with some return on their investment. If we assume for now that the overall market in general is providing a 12% return, we then say that this is the market rate. So I'm going to put an MR here and put 12% right underneath it. Part of the market is Wang Company. Assume it's a manufacturing firm, and they're looking to get some funding from the outside, from some investor, to fund an expansion of the business. They have a choice to either issue equity through stock or debt via bonds. So we're going to actually be using bonds in this example. So we've got Wang Company saying to the investor market, saying, I have a number of bonds in the amount of $1 million. The bonds are for 5 years, that's the term. And the return that I will provide you investors is also the same as the market, 12%. The interest payments are going to be made every half a year, so there are two semi-annual interest payments, making this a 10-period bond. So then 10 6-month periods. Going back to the return on this contract, the 12% here is referred to as a contract rate because it's a contract on the bonds. And as you can see, there's no difference between the contract rate and the market rate. For that reason, there's no need to adjust the pricing of the bonds. So there's no discount and there's no premium here in this example or in this scenario. For that reason, we say that the issuance of these bonds at this point with these two rates is at face. So when we do the actual journal entry, we're going to be doing a very simple set of entries here. The bond issue is simply a loan received or cash received from the investor by Wang. So there's a debit to cash for $1 million, and there's a credit to a long-term liability account, bonds payable. Obviously also $1 million. And since again there's no difference between the market rate and the contract rate, there's no need to do anything else. We're done with the issuance here. Had there been a discount or a premium, there would be another entry here, another debit or a credit, and we'll see that in the follow-up example. With respect to the interest payment, note now that we have to figure out what the interest would be on the first 6 months. So between the issuance and the first payment, there are 6 months that have elapsed. Well, if the contract rate calls for a 12% return on a yearly basis, that means that there's a 6% return to the investor from the bond directly every 6 months. So we multiply the 6% times the $1 million, and that will result in an interest payment of $60,000. The entry would be simply debit to interest expense, $60,000, and credit cash, because we're actually making the payment, and that would be also $60,000. And since in this case, under the issuance at face, there's no discount or premium, this portion of the event here, we don't need to do. It doesn't apply. So we're done. So that takes care of the issue at face.